Hi everybody, welcome to another update on the stock screener. Today we're going to talk about Soma Gold because they have released second quarter financial results. Stock is doing well, it's going up. Actually, it's making all-time highs for the mine that they have right now because the other all-time high was from another operation, but from this mine we have an all-time high of 0.71. So let's take a look at the news release. Not a lot of news. We already knew all of this. They have delivered their target. Production we already knew. Net income was actually higher than I expected. EBITDA 10 million for the quarter. So that's 1.5 times EBITDA, which is very cheap. Cash cost very low, 907. That's a low cost mine. For the first half, we have 15,000 ounces production. You can see all-in sustaining cost is already at 1,050. So the costs are coming down. It was at 1,300 last time. Now it's 1,050. Lots of income, EBITDA positive. So very good. They have exploration properties. They're going to formalize more miners. We already know that. This is the most important. They are still deciding on whether to move the mill or leave it. I think they will move it because it's going to drive costs down. We don't know how much yet. We don't know the initial capex yet, but we can estimate this and see what the upside could be. Strategic additions to the package. Okay, so they're going to buy more land, apparently. So I expect some more news on that. Drilling is ongoing later on this year. They purchased some drills. We're still on target with this guidance. We already know that. This is new. AISC is going to be very low. This is also new. The Aurora mine is going to production next year. We don't know when yet, but I think very fast. It's ready to mine. At first they need to drill a bit and see where the gold is, and then they will start to bring it to the El Bagre mill. That's significant. So they just purchased it and now they are going to mine from it next year. And that will increase the mine life. So these numbers here, you can look at it, but I will show some charts on that. And that's the news release. So let's take a look at the catalysts. So moving the mill, yeah, that confirms the mine life. Land package has been increased. Resources are going to go to 1 million, 1.5 million in the future. AIC is going to go below 900, I think. 900 was the target on the presentation, but that was before moving the mill. So now they're probably going to move the mill and AISC is going to go below 900, I think. Exploration program, yeah, that's going to increase. They want more resources and are starting to buy more packages of land. Artisanal miners are going to double in amount to 10%. Production is going to go up. It will take some time, of course. Net profit is also going to go up in time. Then we get some dividends after paying off the debt. Recoveries are probably already at 90% and rising next year. And Aurora mine is going to go production next year. So what is the status on the valuation? This is the latest status. 70 million market cap. At 1900 gold, there is still upside. Probably a double if we do 5 times net earnings. If we do 10 times net earnings, then it will be a quadruple. But of course, this is a small cap. People will put less money in this, so it has less. It has a lower multiple. But I think 5 times net earnings should be doable. So a double is probably the target. Of course, if gold goes up to 2,500, which is 25% up, which is also doable, then the upside is much more. Then we go to here, 250 million. So that would be how much upside? A triple? Quadruple? Yeah, that's possible. Triple to quadruple based on 5 times net earnings. Financials are given here. We don't have CDR numbers yet, but I think it's going to be here. 3 million net income, equity goes up, operating profits up, revenue up. So everything is up, and we are going to go up much more in the coming months, because production is ramping up, and this will be the full capacity. So I expect these good earnings to become even better next year. SOMA Gold's production is given here. A huge rise in production, around 9,000 now per quarter, going to 12,000 per quarter in the future. So it's looking very good. There's more upside. And as you can see here, the costs are already at 1,050 AISC. This is plus interest payments. So yeah, the costs are coming down. And this is the 900. But as we are going to see in the next slides, this 900 could go even lower. So at 900 AISC, this is a situation. Plenty upside with a 10% NPV. You will get your money back in 2027 and more upside. And you get 10% per year on interest that you can reinvest. So that's a very good return. And this is at 900 AISC. Now, what happens with 800 AISC? Then you get this. So you get your money back in 1 to 3 years. Here it was 4 years. Here it's 3 years. So I think they could reduce their cost by another $100. That's very possible. So I have reduced everything here by 100 because of the mill that they are going to move, and that can give even more upside. So why do I say 100? Well, these are the typical costs segments of a gold mine. We have the all-in sustaining costs, and it consists of cash costs, sustaining capital, treatment costs, and corporate administration. The largest costs are, of course, the mining costs, cash costs. Then we have the sustaining capital, and treatment is probably one of the lowest costs. And then, of course, corporate administration. Then for the cost of sales, that's about 70% of the costs. So a large part of the cost, probably most of it coming from the cash costs. Here we have the mining costs, which is the biggest part, 30%. Then we have the milling costs, 15%, some maintenance costs, some support costs, as you can see here, security, very important, safety, logistics, environmental. That's a big amount of the cost of sales, and then some depletion. Then, of course, we have the transport costs to El Limon. If we bring that El Limon plant online, then you need to transport the ore from Cordero to El Limon, and that's also a cost. Now, if you actually move the mill to El Bagre, then you don't have these transport costs to El Limon, and that is completely deleted. So that would be the cost reduction. I don't know how much this is. Let's say it's about $5 per ounce cost. Let's go with that. Diesel is very cheap in Colombia, so I don't expect too much costs here. What can we actually delete from here if we move the mill to El Bagre? Of course, the transport costs, that's about $5 in AISC. Treatment refinery is also going to drop because you don't need to start up the plant of El Limon. You just use the current refinery in El Bagre. So you don't need to have these costs anymore for El Limon. So that's about, yeah, you delete this in half. That's about 1.5% less costs. Corporate administration, I don't think this can change much. So I would delete this from this chart. We just take transport, treatment, and of course, sustaining and cash costs. These can be improved. From the cash costs, let's see what we can improve here. I don't think that direct mining costs can change because whether you put the mill in El Bagre or in El Limon, you still need to mine it out of Cordero. So I don't think that this is going to change. Milling costs, yeah, you still need to mill the ore, whether it's in El Limon or in El Bagre. So these costs are not going to change much. Maintenance, however, I think here you could make it more efficient, like reducing the maintenance crew, one maintenance crew to maintain both mills at the same location. So this could maybe drop in half. I don't know how much, but this could drop. Support services can also drop because you only need one security crew. You don't need to secure El Limon anymore. You just use the same security crew for El Bagre. Logistics, yeah, You can now just bring everything to one plant instead of two plants. Safety, yeah, community. You don't need to look out for the El Limon community anymore. You just do it for El Bagre. Environmental, yeah, same here. Just do it for El Bagre. So this could actually also drop in half. Depletion, no, I don't think this can be improved. So basically it looks like this. This is what can be improved. Let's say 40% of the cost of sales can be halved. That's 40% of this, of 70%. That's 30%, and that can be halved. So that's 15% less costs. This is just a tiny bit. I will just ignore this. And yeah, 15%. I think we can reduce the AISC by 10 to 15%. And then we also delete the transport cost, which is another $5 per ounce, maybe. So 900 would turn into 800, maybe, because it's minus 10%. So that's how I estimate how much the cost could come down. And that's here, 900 to 800. Now, what is the upside if we go from 900 to 800 cost? That's given here. So this blue line is the upside based on 5 times net earnings. If the costs are reduced by 100 from 900 to 800, so this is the x-axis AIC reduction 100, then the upside is not 90% anymore, but is 120% based on 5 times net earnings. And the additional upside from moving the mill is 30%. So by moving the mill, if the all-in sustaining cost drops $100, we could see an immediate upside of 30% based on this chart. Okay. You can just estimate yourself. Could be 20%, 20 all-in sustaining cost reduction, 50. And here you can see how much upside there is. So it's around 0 to 20% of upside, which is in addition to the upside that we already have from here. So I think this is very good news. I would just keep Soma Gold because you get 20% upside just from moving the mill and an additional 90% upside from 5 times net earnings coming from here. So let's see what their feasibility study is going to show us, and we will get the results in a few weeks. So stay tuned. This was the update. I'll see you in the next video. Bye.